You're listening to the Investor Success Podcast, the hit weekly show featuring inspirational stories to help real estate entrepreneurs do more deals while increasing their cash flow and their net worth. My name is Jim Ingersoll, and I'm the host for the podcast today. Thanks for tuning in. Today, if you're listening on iTunes, Stitcher Radio, iHeartRadio, or YouTube, we want to give you a special shout out and welcome. It's nice to have you along today. I've got a free gift for you today. If you go to bigmoneyinvestor.com/fix-flip, bigmoneyinvestor.com/fix-flip, you can pick up a documentation kit. It's like an easy swipe file, and you're going to love the content of it. So go check that out. I created this podcast to help motivate and inspire people to take massive action and build your investing and your life the right way, the way that you want to carve it out. And I want to welcome you to our show today. Today we're going to focus on assets that create long-term and long-lasting perpetual wealth that won't go away. I also want to thank all of our regular Success listeners. It's great to have you back. Thanks for your feedback. Thanks for those who have been leaving me some review in iTunes. I really appreciate that as well. If this is your first time tuning into our show today, I encourage you to go check out the other shows and the other episodes as well. You're going to learn a ton. You're going to be inspired, and you're going to want to go out and take action investing in some great real estate deals. We have a fantastic show lined up today with a really inspiring guest that you're going to absolutely love. And our guest today is Dr. Buck Joffrey. Buck, welcome to the Investor Success Podcast today.
Thanks for having me, Jim.
All right, let me tell you a little bit about Buck so you can get to know him before we hear his story. Buck is an accomplished physician, entrepreneur, asset manager, and a podcaster. You're going to love his podcast as well, and we'll get you to hear about that in a few minutes. Since finishing his medical training in 2008, he's had phenomenal success through his startup businesses and his investments, going from being broke to having an 8-figure net worth. And in order to help his high-paid professional colleagues, he started a financial educational website called wealthformula.com. You're going to want to go write that down and check it out, wealthformula.com. And host the popular Wealth Formula podcast as well. Buck knows the old mantra of investing in a diversified portfolio of stocks, bonds, and mutual funds is truly outdated and dangerous for high-paid professionals, given the volatility and the instability of the current global economy, and I couldn't agree anymore. Therefore, he advocates entrepreneurship and or investing in hard assets that produce a cash flow in a more reliable way of approaching personal finance. So through a strong foundation of financial education, emphasis on cash flow, Buck teaches professionals how to take charge of their money and absolutely prosper in today's market. Buck, welcome. It's nice to have you along today.
Yeah, thank you, Jim.
So tell us a little bit about your backstory and let us get to know you a little bit more.
Yeah, so I am your typical A student. Went to school, got straight A's. Went to college, got straight A's. Went to medical school, graduated Phi Beta Kappa. Wow. Started out in a neurosurgery residency. Switched over to head and neck without the brain. Finished this residency in 2008, and at that point, up to that point, all I was really concerned about was being the smart kid on the block, and doing things that sounded really smart and scary, and I had some significant interest in research and that sort of thing as well. But in 2008, by that point, I had sort of gotten burned out a little bit at the whole idea of academics and academic medicine, and I was looking for something else. And I did do a facial plastic. I did a head and neck surgery residency, and then trained also in facial plastic surgery. So I had training in a lot of things. I decided to take my shot at the facial plastic surgery and cosmetics world. So I went in, started working for a company there pretty quickly after residency, and started to realize pretty quickly that this corporate world wasn't really for me, because the way I like to do things as a physician, as a surgeon, and so on and so forth, were getting heavily influenced by the corporate side, and I didn't like being told what to do. Long story short, about 7 or 8 months into it, not because of, any quality of care issues, but just because of my lack of wanting to, practice the way that the managers wanted me to rather than the way I thought a physician should. They fired me. And that was probably the best thing that happened to me because the first time in my life, really, it was a major failure. And, I wasn't used to it. So I realized that, for me, the idea of going out and getting another job just wasn't going to work because I'm sure the managers that fired me, I had my reasons for not liking them, but they had probably pretty good reasons for not liking me. It's a world where if you work for somebody, you kind of have to do what they tell you to do. And I wasn't interested in that. And so at that point, I started my first business, and I started my first business. It was similar in character to the one I was working for. And I didn't know anything about business, but went out there and, through the school Hard Knocks, started it up. I ran it like a business, did heavy marketing, TV, internet, radio, and before you know it, 18 months later, I was a millionaire.
Wow.
So that's how it started. Yeah, and right, that's right. And the cool thing about it was I didn't know anything about business. This is really important, okay? Because there's people out there right now saying, I'm a professional. I studied for this, I studied for that. Well, geez, you're talking to a guy who was drilling through skulls, right? I had no idea about money, about anything, and other than my craft. And I started a business, and I did it because I taught myself. And then I got the bug, and then I kept starting other businesses and buying real estate. And before you know it, I became a serial entrepreneur, and then I had to figure out what to do with the money, so I had to teach myself how to invest.
So back in those early days, what were some of the businesses that you did that you actually enjoyed and did well with, having left corporate America? Yeah,
so after leaving, I started, my first business was this business in cosmetic surgery, and that was the one where I was practicing and where I made my first stash of money. And after that, I started getting into the real estate business and bought some real estate. And I consider those businesses again because they're not just assets. They have money coming in, money coming out, and there's a manager, and I'm not there every day. So they're businesses I own. So I bought real estate. I also started another business in the health and the allergy and sinus business, and then I started another one in the autism business. These are businesses, some of them I didn't know anything about. Right. So they weren't like, well, gosh, you're a doctor, therefore you could do it. They just happened to be things that I learned about, and I thought they were good business models. So that's basically it.
So how did you get started investing into real estate? And what did those first investments look like, and how long ago was that?
Yeah, so I started investing, shortly after I started making money. So when I started that business, and all of a sudden I had this money in my pocket, I had to figure out what to do with it, and I never really thought about it because I never really had any money in my pocket.
Right.
But I went back to this, the fact that when I was growing up, my dad, and he continues to be, he's a landlord. Mm-hmm. Now, he is the classic landlord. He's the guy who gets every phone call for every issue, and he literally gets phone calls from people looking for apartments that he shows them himself. But he did really well throughout his life. Yep. But the one thing I'll tell you is that I got from watching that was I had no interest in being a landlord. Mm-hmm. But what I did see was that he made plenty of money with real estate. And I didn't understand the stock market. I looked around, in 2008, that's, pretty good time to see what was going on. And I saw all these people losing, half their wealth in a matter of days. And I wasn't interested in that. So I wanted to go out and invest in things that I thought made sense, and I saw work for my dad for my entire life. So real estate is where I started. And at that time, you can imagine there was some pretty good deals around. That was pretty much it. I mean, it was a good market to get started in. I made some mistakes early on, but overall, came out pretty well.
Well, real estate is pretty forgiving, and all of us make mistakes. Anybody who tells you they didn't make mistakes in real estate is not telling you the truth. but if you buy right, it's reasonably forgiving. And if you hold on to stuff over time, it forgives itself that way as well. But were you investing like in single-family homes? How did you get started?
I never started with single-family homes. Okay. I started directly into multifamily, commercial, apartment buildings. So generally over 10 units. And the reason for that was that, I wasn't planning on being a landlord anyway. Right. So to me, it didn't matter how many units there was. In fact, the way I thought about it was in terms of, what's the thing you don't want when you have a rental? You don't want vacancy, right? Well, with a single family house, you got two options. You're either 100% vacant or 0% vacant. And so I didn't like the idea of that. I like the idea of having more doors to again sort of hedge that hedge vacancies. Yeah.
So that's great. So you started buying small apartment complexes, 10 plus units. And where were you at, like in the country? Where were you living at that point?
Chicago, and that's where I am now. But and that's where I was focused on.
And that's been a really good market the last several years. So that's good. So give me some ideas why you went with buying that type of asset in that class, knowing that your goal was to create perpetual wealth.
Well, I mean, I think you have to look at a little bit broader. I look at it a little bit broader. Okay, obviously, cash flow is a big deal, but if you philosophically, I believe in investing in real assets. And real assets can be real estate, land, precious metals. I mean, these things are real wealth. I mean, they don't lose value overnight just because there was a computer glitch in Wall Street or because a bank like Lehman Brothers goes out of business. When the markets crashed in 2008, a lot of people literally lost their wealth overnight. And that's not real wealth. I mean, that's owning worthless paper is what that is. And what we know from history is that that real assets maintain value over time. And in most cases, they'll actually increase in value. If you look, for example, at gold. Gold is a great example of a real asset. Now, it's actually money. Gold is money. That's the way I like to think of it. So I don't think of it as something that's going to throw off cash flow. But it's a real asset. And it's a real asset because an ounce of gold would buy you, in ancient Rome, could buy you a fancy toga. And an ounce of gold today will buy you a fancy Armani suit. Okay? That's real.
I love that, Buck. Well. That's good. Yeah, that's where the rubber hits the road, right?
That's right. So what you have there is you have something that maintains value, right? And so when you look at the families throughout time, throughout the world that maintain generational wealth, in Europe especially, you see that because there's, hundreds and hundreds of years these people have had, they've had wealth. They've been wealthy families for 500 years. And it's not because they owned a bunch of paper. They didn't own stocks, bonds, mutual funds. It's because they own real stuff, So that's really what it's all about for me. So I am a big fan of real estate because it also throws off cash flow. But I mean, listen, I'm also a big fan of energy investments, a big fan of owning other people's debt. I mean, again,
be the
bank, nothing else. So there's lots of things that they're easy to understand, they're real, and that's what I like to own.
Let me ask you this, because you've invested in a lot of apartment complexes. What are some fundamentals if somebody's looking to, say, migrate from single-family homes to apartments or just getting started? What would a good deal look like, and what should some of that upfront due diligence look like?
That's a good question. First, I think let's talk about why you would want to transition to multifamily from single-family houses, because I think that's really something to think about. And the reason that I like multifamily, in addition to the idea of not 0 versus 100 vacancy, is that there is, first of all, it's scalable. Okay, you have that whole idea that you can get more people in, and you can use some of the same resources to take care of those residents. The next thing, and probably one of the most important things to me, is the way that a multifamily asset or any commercial asset is judged in terms of its value is not really that subjective. Okay, you might look at a house in a neighborhood and say, well, this house is worth, $50,000, it's worth $100,000, whatever.
Right.
And the rent you get from that, hopefully you get a rent that, it makes it so that you make a few bucks on the property once the mortgage principal and interest is paid. But that, in my mind, is a little bit speculative to a certain degree. The beauty of a commercial property, which I mean specifically residential commercial, 5 units and above, is the way that it's valued is dependent entirely on the net operating income. So what that means is, it's not what somebody looks at it and says, gosh, this house, it's worth $80,000, $90,000. No, what it is what the net operating income is, what, the cap rate in the area is, the capitalization rate, and it's simple math, right? So the other beauty of it is, if you want to increase the value of that property, you can force equity into it. So if you can say you've got a 100-unit building and you increase rent in every one of those units by $100, that's going to increase the net operating income and therefore the value of the building. So it's a very predictable
forced appreciation
investment. That's right.
What kind of cap rates should people be looking to pick up these days? Because they're lower than they were before, it appears.
Yeah, it's ridiculous right now. And here's it's a tricky question because, first of all, it's market dependent, as all real estate is about the market. The second issue is the size of the apartment unit, apartment building.
That's a good
so
point.
As you know, right now those big investors, those institutional investors that used to sit in the stock market and bond market, they're all trying to find a better place for their money. So a lot of them are actually moving into purchasing large apartment complexes. So the challenge is that the bigger apartment complexes, the ones say in the 10 million and above range, it's a very crowded space, particularly in the larger markets. So that's Chicago, whether that's now Dallas. The Chinese are going to Dallas. But when it gets crowded like that, syndicators like me, people who are trying to put together deals for investors, we get squeezed a little bit too, because we might have been looking at putting together deals for our investors in the neighborhood of $7 to $12 million, but now we're getting pushed down because the cap rates are squeezed down there because of the institutional investors.
Right.
So ironically, the best deals are the cheaper deals. Okay. And the problem with getting too cheap is that you run into too many mom and pop investors, and they all want in. So you have to be expensive enough for the mom and pops not to be able to reach it. So you might say, okay, maybe it's $1 million property, but you have to keep out of the range of the institutional investors. So it's going to be somewhere probably below 4 million. So 1 to 4 million. Now, specifically with cap rates, it's dependent very much on location. In Chicago, in 2012, I picked up a couple of buildings with cap rates near 9.
Wow.
And after leverage, the return on investment was ridiculous. It's 15% plus.
Right.
But now those same areas, those buildings are now with cap rates around 6 or sub 6. It's hard to make money on that. It's hard to make
created
money.
Nice equity for the ones you did pick up.
Oh, huge equity.
Because if you bought it at a 9 and it's worth a 6.
Yep. Over seven figure equity gains in both of those buildings I bought.
So those are great tips on cap rates. So you think the sweet spot's $1 to $4 million. That way you avoid the institutional investors, and you also avoid the mom and pop guys picking up quads and things like that are cheaper. So maybe 10 to 20 units.
And I'll tell you that, some of your listeners might be out there going, well, listen, I haven't invested in real estate, and $1 to $4 million sounds like a lot of money. Well, it is a lot of money, right? But there are syndicators, including myself, who are looking for deals in that range. So if you're willing to be a limited partner on a deal, you can still very likely, get deals that are going to throw off double-digit returns. But it's sort of hard to do this. I would say, as an individual investor, it's probably not the best time in the world to get in the market.
Tell us a little bit about how the syndicating works and what you offer in that regard, and of course how people could get a hold of you if they want to work with you.
Well, so syndication is essentially just it's getting to participate in ownership of an asset, and we call it fractional ownership. So, for example, you look around. You may look around and you're driving and you see these great big towers, or you see, these great big apartment complexes. Very, very rarely are those buildings owned by a single person. They're owned by, or a single family. They're typically owned by what's called a syndication. And a syndication it's a group of investors led by somebody called a syndicator or a sponsor. And the syndicator or sponsor is typically the person with expertise in the area who identifies the deal, puts the deal together, makes it make sense, raises the money from the investors, and then the investors act as limited partners in the deal. So the value of that is, now the sponsor obviously is going to take a certain cut of the deal for putting it together and managing the asset as the asset manager. But the advantage to the limited partner is they get all the benefits of real estate, notably the cash flow. They get, and bigger than that probably, is the depreciation. So, for example, if an investor is getting 8% return on investment, which may not seem huge, because of the depreciation offset in multifamily real estate, that 8% will be a real 8%. It won't be 8% and then taxed at capital gains. So, for example, if you did 8% in a deal like this, you'd get to keep. In most cases, you're going to be able to keep that full 8% without being taxed on it. It's tax deferred. It's tax-free income. And
that's one of the beauties of real estate assets that produce cash flow. The depreciation benefit is enormous, and I always love it in April of every year, watching it really come into play, and it's just a huge kick for a great benefit for sure. Of course, if you resell, then you got recapture and other tax things, unless you do a 1031 exchange, of course. But it's a great way to go, and it's a huge, huge benefit. So a syndication that you're doing is similar to a fund?
Yeah, there's a couple of different things that I'm doing. One is, I'm still in the process of, looking for deals. As you mentioned, the deals are a little bit tougher. I'm looking in a few different markets. I'm looking in Chicago. I'm looking in Dallas. I'm looking in Oklahoma, and so putting together deals for investors. That's one thing. The other thing that I'm working on, which I haven't really I haven't completed yet, but I think it's a good project, is to create a fund. And it's essentially a fund. It's an opportunistic fund that allows me as the fund manager to go out and try to put our money into things that are making money. Just to give you an example, there are people I know who've got great opportunities out there that are yielding 10 to 12%.
Right.
But you may not want to put all your money in one fund. I mean, of course, there's always risk to everything, right? So with this fund, what we'd do is we would create a a diversified portfolio of real asset investing. So I think it's a pretty unique opportunity, and I'm still working on putting it together. But I think it'll be a great option for people, particularly if you look at what the alternatives are. I mean, if if you're in the paper markets right now with such volatility with all the equity markets, you have no idea what you're going to get. And the goal in this kind of fund would be, okay, well, you may not get 12%, but you might be able to get 8% on a regular basis and not necessarily worry on a day-to-day basis, if Lehman Brothers went out of business. So,
and I think capital preservation is something that people are legitimately worried about with the stock market and things like that. I mean, I think people have legitimate reason to wake up in the night and be nervous.
Yeah, I agree with that. In fact, I had a big chunk of money sitting in Deutsche Bank, and I had, I just recently realized, gosh, these guys might go out, and the FDIC is only going to, protect you for about $250,000, and there's all these new regulations that a lot of people don't know about with regard to bail-ins and that sort of thing going on. If you've got more than $250,000 in any account, and that's not a lot of people, but there are going to be people out there. Right. I would think twice about separating that out into separate banks.
For sure, I totally agree with that. All right, do you have any success tips, habits, books you've read recently that you could share with our listeners as well?
Well, I mean, in terms of entrepreneurship, I think that the thing that I've realized is that it sounds kind of basic, but you just have to go out there and try, right? The problem with the way that we are programmed in our educational system right now is that when we're growing up, we're told everything that we need to do and what to learn and everything in order to be a success. And the problem with that is that the real world doesn't work that way. And that's why a lot of people find this certain level of apathy, or it's not even apathy. It's just the kind of sense of, I don't know what to do because, no one's telling me what to do. And that's why it's so easy for, guys on Wall Street to come and tell us what to do, and then we do it. We just put our money into things they tell us what to do. But in the real world and with your money, you actually have to go out there and you have to make an effort to learn about things. And in the entrepreneurial world, you're going to have to go out there and take some risks. And you might fail. But the good thing is that whenever you fail, you will learn. That's when you learn. I've had plenty of failures and I've had plenty of successes, and I haven't learned nearly as much from my success as I have my failures.
Yeah, and that's a great tip. Don't be afraid to fail. And I think the key when you do fail is the recovery period. So if you fail, just get up off your feet, get off the ground, and get yourself moving forward again. I think is really critical. Is one of the things I've learned is it's okay to fail. It's good to fail. You're going to learn a lot. Just get yourself up and get moving quickly. Don't delay.
The other thing I would say is in terms of investing, there's a concept that, Jim, which is velocity. All right.
Oh, yeah.
And I think that's something that is really important. It's one of the reasons why I'm thinking about starting this other fund for my investors, because a lot of us are sitting around waiting for the next big deal. And the challenge with that is that they don't always come around. And in the meantime, your money's sitting in the bank making less than 1%. The important thing is not always the return on investment. There's capital preservation, and there's also the idea of continuously putting it in something that is going to continue to make money. So if you find in a fund, say in a fund you could do 7 or 8%, but you can start it today, or you could wait 6 months for the next real estate deal. It might be a good idea to put some of that money into something right now and make it grow. Okay,
great tips. All right, and everybody, make sure you check out Buck's website. It's wealthformula.com, and his podcast as well, which is the Wealth Formula Podcast, because you're going to learn a lot. As you can tell, Buck is very, very smart, and he's got a lot of experience to share. So go to wealthformula.com. Check out his podcast, also Wealth Formula Podcast. Buck, I want to thank you for being my guest today. It's been really good to have this discussion on building perpetual wealth.
Thank you for having me.
All right, that's it for this very special episode of the Investor Success Podcast. Thanks again for tuning in on iTunes, Stitcher Radio, iHeart, wherever you're listening today. Thanks again for all of our loyal Success listeners. We really appreciate you guys, and it's been great to share this time with you today. My name is Jim Ingersoll. I'm not only the host of this podcast, I'm also the founder of the Investor Success Mastermind. And you can check out all the information on our mastermind at investorsuccessmastermind.com. And get out there and make some deals. Put deals together. Don't be afraid to fail. We heard that today. And you may want to go back and listen again, take some notes, because we have a lot of great information on multifamily investing as well. Thanks again, everybody, for tuning in, and have a great day.
Thanks for joining us today. Be sure to share this podcast with your friends and social media contacts, and visit us online at www.bigmoneyinvestor.com.